Hi, everyone. I'm Jessi Chadd. I am with Aspire Wealth Partners, where I serve as a wealth manager. We wanted to bring to you today a quick webinar that hopefully you will find very helpful in these times that we're going through. You know, we work with our clients to help them clarify their goals, create plans around those goals, and take action. And we partner with them as they move along the journey that is their life. But along with that, we also provide to our clients education. You know, the investment world and the financial world can be very confusing because it can oftentimes feel like it has its own language. And sometimes it seems as advisors were speaking a foreign language. So what we wanted to provide to you today is to demystify some of these common terms that you likely hear if you're talking to somebody in personal finance or just reading the news. We want to go through a couple of the common terms and leave you with a whole glossary that I encourage you to print out or save somewhere that you can access it readily when you come across a term that maybe you don't know the definition to. And hopefully this can help you further your education around investing and personal finance. So let's get started. Again, we'll make this glossary available to you so that you have the full glossary. I'm just going to touch on a couple of the key terms that I find come up almost every day when talking with clients. The first one is the term asset allocation. Asset allocation is similar to diversification, which is another kind of one of those foreign language terms that shows up in investing. Simply, the idea of asset allocation, the idea of diversification is do not put all of your eggs in one basket. It's about having a mix of investments that will make up your investment portfolio. Spreading your investments between different asset classes, such as bonds or stocks or cash, we believe can help you minimize risk. The reason for this is because investment categories, like we just described, don't always respond to changing economic and political climates in the same way. This helps to minimize the great ups and downs. If one piece of your investment portfolio is really up, another piece of your investment portfolio might be down. And if that's the case, then we know the diversification or the asset allocation is working. The use of asset allocation doesn't guarantee returns or insulate you from potential risk, but we do believe that it is a prudent way to invest money in today's environment. The next term that you will often hear is the term benchmark. Sometimes it's called an index. If you've listened to the news or read the news, you've likely heard of the Dow Jones Industrial Index average, or sometimes just called the Dow, or the Standard & Poor's 500 Index, often called the S&P 500. And they're usually reported daily, and they're given, you know, the S&P was up or down, or the Dow was up or down this many points. Well, what does that even mean? Well, what they're measuring, what these indexes or benchmarks are measuring, is how did a group of securities perform over that period of time? And those benchmarks and those indexes can be helpful to get a sense of then how well are my investments doing. But there's a fallacy here. We just learned about diversification. If we look at the S&P 500 and we look at the Dow Jones and we try to compare that to a diversified portfolio, it's not apples to apples. We're using the wrong measuring stick. So we have to keep in mind when we're using these measuring sticks of indexes and benchmarks, are we comparing apples to apples? The next term I wanted to define was the term bond. You've likely heard of a bond. This is a debt investment that is issued either by a corporation or a government to an investor. Simply works, the borrower, which is the company, they need to borrow money. They will repay that loan plus interest to the investor, which is you. We're not typically used to being on that side. We're used to typically being the borrower, but in this case, it's opposite. Similar to a bond, you've probably heard the word stock, or sometimes referred to as equity. This represents an investment ownership in a corporation. So not a loan, but you actually own a piece of the company through what is called a share of stock. These two tend to go together. Investments can be stocks or bonds. And usually you can go out and buy them individually, but a lot of times we're buying stocks and we're buying bonds inside of a fund. So I want to take some time to define the different funds that are out there that you might be encountering as you are looking to invest your money inside your 401k, inside of an IRA, or just inside of an investment account. This term exchange traded fund next, ETF, is getting a lot of buzz right now. And they can be confusing to understand, so we wanted to define it. An exchange traded fund is a type of investment that involves a collection of investments, such as stocks, that they track an underlying index, but sometimes they can be invested in a number of different industry sectors or various strategies. So they can be broader than just saying, I'm going to buy stock that represents large companies in the US. Sometimes they're broader than that. They're similar to a mutual fund, which we'll talk about. However, you buy them differently. You can buy them throughout the day, just like you would buy a stock. So you get the price at that point in time. Similar to an exchange traded fund is an index fund. I'm going to skip ahead and then I'll come back to the term that I skipped. An index fund is a type of either mutual fund or exchange traded fund that we just learned about, but they're more simple. They're just looking to track or match the components of a financial index, such as the S&P 500. An index fund is said to provide broad market exposure, so it tries to track just what the S&P 500 is doing. These usually come with lower operating costs and lower turnover inside of that portfolio. Their objective is to follow the benchmark regardless of what the markets are doing. So we have exchange traded funds, we have index funds, and then we have mutual funds. Mutual funds have been around for a long time. A mutual fund is an investment company that is registered with the SEC that buys a portfolio of securities selected by a professional investment advisor. The mutual funds can either be actively managed, which means that the investment advisor is looking to create a unique mix of investments to meet a particular investment objective. So when we buy mutual funds, it's very important to look at what is the objective of this mutual fund. Is it growth? Is it security? Is it income? Or is it a combination? Depending on what the objective is, then the underlying investment should align with that objective. They can be more passively managed, meaning that the advisor is just trying to match the performance of a selected benchmark or index, similar to what we learned about an index fund. I'm going to go back then to the term fiduciary. A fiduciary is another kind of buzzword that you maybe have seen in the news over the last several years, because there's been a lot of laws and legislation coming out around how people are defined and who has to act as a fiduciary in the investment world. A fiduciary is a person or an organization that will act on the behalf of another person or persons to manage assets. We at Aspire act as fiduciaries for the benefit of our clients. Basically, what that means is that we state that we will act in the best interest of our clients. It is the highest legal duty of one party to another, the highest legal duty of how one can represent another. And we are ethically bound to act in the best interest of others. I think this is an important term for you to know, because if you're going to invest money and you're going to utilize somebody to help you invest that money, you want to make sure that they're acting in your best interest and not necessarily just picking investments that appear to be suitable for somebody that is your age or in your stage of life. It's a higher sense of care that is provided. The next term that I wanted to define is the term IRA, individual retirement account. Now, IRAs come in lots of different flavors, but the two that we hear about most common are a traditional IRA and a Roth IRA. And you may have asked yourself, should I be investing in a traditional IRA or Roth IRA? And how do I know the difference? Traditional IRAs are typically investments that are made pre-tax. We're putting money into the IRA on a pre-tax basis, meaning we're getting a tax benefit today. We put that money into an IRA, we don't have to pay tax on that money. And the earnings, so an IRA gets invested either in stock or bond or mutual fund or exchange traded fund, and the earnings are tax deferred, meaning that we don't have to pay tax on those earnings today, but we pay the tax on the contributions and the earnings when the funds are withdrawn, which typically happens once you're retired. Conversely, Roth IRAs our contributions are made post-tax. So they get a kind of a bad rap because there's no tax savings today, and who doesn't want to save taxes today? However, because the contributions are made after tax into a Roth IRA, the earnings grow tax-free under the current law. You never pay tax on that money that grows inside of a Roth IRA. So they're a great savings vehicle if they're available to you for future investment growth and taxation. The next term that I wanted to define was investment return and investment risk. Return and risk go hand in hand. In order to generate a higher return inside of an investment, we have to be willing to take on a higher level of risk. Meaning, if we want to have big returns, we have to acknowledge that there's the other side to that coin, which is the opportunity for big losses. So returns are the gain or loss on an investment over a certain period of time. You'll typically see that expressed as a percentage. So my investments went up 10% last year, or maybe my investments went down 10% last year. That's the return that you generated on your investment. The risk then is the possibility of losing some or all of the money invested, or not gaining value in an investment. And the last term that I wanted to talk about today is the term of volatility. We specifically wanted to talk about this term because we've seen this come up a lot in the news and the media, because we've gone through a period of time with the US stock market having high levels of volatility. What that means is big ups and downs, or little up and downs, but volatility represents the amount and frequency of fluctuation in the price of a stock, a market, a commodity, a bond, you name it, over a specific period of time. So take, for instance, cash. We know we don't generate a big return usually on cash, but we also don't experience a lot of ups and downs with the value of our cash. It stays pretty steady for the most part. That is a low volatility investment. Converse that with the US stock market and what we saw happening in February and March, where we saw record highs for the year, and about a month later, we saw record lows for the year. That's a high level of volatility. That's a high level of ups and downs. Generally, an investment with high volatility is said to have greater risk because the increased chance that the price of the security will fall. There's also greater risk for or greater return. So volatility, simply think of it as the roller coaster that an investment or a market might be on. Sometimes we have low volatility and sometimes we have high volatility. I know I just gave you a lot to think about. We defined a lot of terms in a short period of time, but my hope is that you pulled something out, that you've heard a term, and now you feel like you have a clearer definition on how to think about that term. I'd encourage you to read through our entire glossary. We'll make that available to you, and reach out to us if you have questions. If you're looking for a partner that would help you put together your financial plan and think about your financial life, or you're going through a big transition right now and you just need help and you need a partner in that. Or if you're looking for some additional financial education, we're here for that as well. We look forward to hearing from you, and thank you.